Hi, I'm Todd Rosenbluth, Head of Research at Vetify, and thanks for joining us for our latest episode of ETF360. I'm excited to be joined by Alexandra Lawson of Goldman Sachs Asset Management as we talk about their fixed income ETF suite. Alexandra, thanks for joining me.
Todd, thanks for having me.
It's my pleasure. So we're now in 2023, but 2022 was a really strong year for fixed income ETFs, despite the fact that people were moving money out of fixed income mutual funds. Almost $200 billion of net new money came into fixed income ETFs. What do you think the attraction is?
Yeah, great question. It's been sort of a culmination of a trend that's been happening for a few years, and we've just seen much wider adoption last year. There are more fixed income ETFs in existence, right? ETF adoption at the institutional level, as well as at the advisor retail level, has increased. And what's been really interesting is that last year, right, with the Fed in play, they've been trying to fight inflation. And when inflation is driving asset values, you tend to get markets that are very correlated. And so the big driver last year, being inflation, that has a big impact on the interest rate market. And so whether you were in high yield, whether you were investment grade, whether you were in treasuries, whether you were in bank loans, right, unfortunately, all experienced negative returns. And so that's allowed investors to do a lot of tax loss harvesting. They may not have had that flexibility when they're sitting on portfolios with gains. So that window of opportunity, even though it's been in a painful period of time, has allowed people who've been looking at ETFs, maybe sitting on the sideline, to actually step off the sidelines and invest. And we expect that trend to continue.
So you mentioned the Fed obviously being a major factor in 2022. In 2023, do you expect a less aggressive Fed?
We do, yeah. So our opinion here at Goldman Sachs Asset Management is 2022 was the Fed fund rate at 0, going up to north of 4%, so 400 basis points of Fed increase. Our estimate for this year is another 75 basis points. So whether you get that as a 50 basis point hike in February, followed by 25, or 3 smaller 25 basis point hikes, that's the expectation. So that alone is a big shift in magnitude. 0 to 4% versus, let's say, 4% to maybe 5%, much different impact. And what does that do for fixed income? Well, we've restored value. Again, very painful, right? But we've restored value. What do I mean? Yields now in fixed income have gone from 2 percentage points or so to somewhere north of 5%. And that 5% allows for a greater buffer to price movement because of interest rate or Fed activity. We did not have that buffer at the beginning of 2022. So yes, 2023, we're more optimistic for fixed income in this coming year than we were for the past year.
So let's talk about the Goldman Sachs fixed income suite of ETFs. What makes them different than a more traditional approach to index investing?
Okay, thank you, Todd. Yeah, so we launched 8 access ETFs within our fixed income franchise, co-branded with FTSE Russell. So the indices are based off the principles of active investing delivered in a passive framework. What does that mean in reality? Well, we're looking at things like liquidity in the market. We're looking at things like fundamental screens. We're looking at technical movement in the market to systematically try to deliver better risk-reward outcomes. So if we look, for example, we've got an investment grade ETF, our access investment grade ETF, GIGB. And in there, what we're doing is we're trying to identify and eliminate the bottom 10% of issuers. We're looking at a fundamental screen there where we're saying, look, if your interest coverage is deteriorating, if your leverage is increasing quarter over quarter, you're going to get screened out. We screen out that bottom 10%. So that's not to say it's a rating screen, right? You could be a triple B issuer and you could be improving. You could be a single A issuer and deteriorating. And so you could have one bad quarter, or this could be the beginning of a trend of a deteriorating credit. And we've looked at that, and there's predictive power to looking at, again, interest coverage as well as leverage, as an example.
So you mentioned Gig B. Let's just maybe touch on another one of the products, GHYB. That's one of your high yield ETFs. What makes that one different?
Yeah, very similar. We're looking to screen out, in that case, the bottom 15% of deteriorating credits. And there we're going to use, again, your leverage, right, and your interest coverage. And so what we're looking at there is any potential deterioration quarter over quarter. And remember, with bonds, very different than stocks. There's limited upside. So we're not looking to find a few winners. What we're really looking to do is avoid the losers. That's the power in fixed income investing and in the systematic approach that we're using within our Access suite.
Well, that's great insights to learn more about the systematic Access suite of ETFs from Goldman Sachs. Alexandra, thanks for joining me.
Todd, thanks very much for having me.
Thank you, and hope everybody has a great day.